Disclaimer: the information provided in this video is for educational purposes only. Trading on margin involves significant risk. A 2 to 1 leverage ratio means that while gains are doubled, losses are also doubled. You can lose more than your initial investment. Always consult with a licensed financial advisor. You've worked hard to save $100,000, but if that money is sitting in a traditional bank account, it is losing value every single day. At 4% inflation, your $100,000 buys less every year. To build real wealth, you must move from being a saver to a wealth builder by increasing the velocity of your money. Most people are taught all debt is bad, but strategic debt is your greatest friend when used to buy assets that grow. In this current cycle of interest rate reductions, debt is no longer a burden. It is a ladder. When the cost of borrowing is lower than your returns, you use the bank's capital to reach financial freedom twice as fast. How do we put this into practice? You move your $100,000 into a securities account and utilize a 50% margin facility. Your cash, $100,000. Borrowed margin, $100,000. Total purchasing power, $200,000. You are now earning dividends and growth on double your initial capital. By targeting a basket of high-quality securities earning an 8% annual dividend, the math of the wealthy takes over. Gross dividend income, $16,000. Cost of debt, $3,500. Net annual profit, $12,500. That is a 12.5% net return on your original cash, simply by using the bank's money to expand your position. When you reinvest that $12,500 profit to buy more shares and maintain your 2 to 1 ratio, your growth accelerates exponentially. Here are your 3-year milestones. Timeline net cash equity total assets. Start, $100,000, $200,000. Year 1, $112,500, $225,000. Year 2, $126,560, $253,120. Year 3, $142,380, $284,760. In just 36 months, your cash value has increased by over 42%, and your purchasing power is approaching $300,000. But how do you survive a crash? We keep our margin safety at 50%. Historically, even the most violent crashes rarely exceed a 30% drop in a short period for quality baskets. With a 50% buffer, even a sharp 30% correction won't trigger a margin call. You stay calm, collect your dividends, and wait for the recovery while others are forced to sell at the bottom. To manage this safely, Rule of 5. Invest in 5 or fewer securities so you can monitor every detail. Quarterly reviews. Every 3 months, check dividend health and interest rates. Active rebalancing. Sell winners to buy laggards, ensuring your 50% safety buffer is always reinforced. Where do you find these 8% yields? We look to the established hubs of Singapore and Hong Kong. In Singapore, REITs and high-yield blue chips are the primary candidates. For example, Sasser REIT currently offers an attractive yield above 8%. In Hong Kong, counters like China Everbright provide similar high-yield opportunities. However, a word of caution, not all shares are marginable. Securities firms maintain a list of approved stocks they are willing to lend against. High volatility or small-cap stocks are often excluded. To make this strategy work, you must choose from the approved margin list to ensure your purchasing power is unlocked. Your $100,000 is a tool. In a world of falling interest rates, strategic debt is the fuel for your engine. By using 2 to 1 margin wisely, selecting marginable high-yield assets in SG and HK, and respecting the 50% safety buffer, you are taking the fastest and safest route to financial independence. Stop saving. Start building.